Welcome back to the Keiser Report. I'm Max Keiser. Time now to turn to Egon von Greyerz of goldswitzerland.com. Egon, welcome back.
Thank you, Max, and a bit of a late Happy New Year to you.
You write on your website a little piece called, "We Just Left the 2010s, the Decade of Fantasy," as you call it. What is this all about, the Decade of Fantasy, and what's coming up in the next decade?
The Decade of Fantasy was a decade that the world managed to artificially, or the world central banks, to artificially let the patient survive for another 10 years, which was absolutely a lot longer than I ever expected was possible. But nevertheless, by printing fake money and by charging zero or negative rates for it, they fooled the world for another almost 10 years. Well, it actually was 10 years. And now, therefore, we are at the peak of bubbles. We are at the Uber bubbles. I think the 20s will not take until 29, like it did in the 1900s, until this whole system collapses. I think it will happen a lot sooner, and it's likely to start this year, and it could start anytime now. The risk is at a maximum. Things don't always turn when you expect to, but it could happen. It could happen this week or next week, or it might take a bit longer. But I don't see these bubbles lasting for much longer.
This has been the story for a number of years. As you point out, we've been talking about this for 10 years, that on a valuation basis, on a price earnings basis, on historical basis, markets are overvalued. Certainly the bond market's in a 300-year bubble in the United Kingdom. It's in a 240-year high in the United States, or bubble in the United States, and yet there doesn't seem to be any end to this. Now, during the 10 years that you just talked about there, the Federal Reserve Bank in the U.S. alone printed over $16 trillion to keep these zombie banks and zombie corporations alive. Remember, a lot of these corporations report no earnings at all. They're only kept alive through stock buybacks and cash infusions from the central bank. But my question, Egon, is, I don't see that ending anytime soon, because the central banks could very easily buy another $15 to $20 trillion worth of bad assets. They all work together. All the major central banks work together. There's no sense of competition in the world like David Ricardo talked about during the first years of neoclassic economics. It's all collusion. They're all buying horrible junk, and they're all working together, and they have printing presses. So why would this end anytime soon, Egon?
Things don't always end when you expect them to, and as we just said, this bubble has been going on for 10 years. You should have collapsed 2009 at the latest, or 7 even. It didn't. But you know, the theory is very simple. If you from 2006, when the crisis started, world global debt was 125 trillion. Since then, another 140 trillion has been printed. So we are around 265 trillion now. And remember, all of that is just air. It's bubbles. It's nothing to do with real money. And that money has been invested into mainly the stock market. It's not gone into the real economy. So they manufactured fake money, and that has created fake wealth. Now, how long do you think the world can continue to live on just thin air, or on fake money and fake assets? I think we have now reached a point when the sheer weight of the debt will actually mean that this system will collapse in the next, it could be this year, or it could, obviously will take a few years, but as a start will be this year. Now, well, you can't fundamentally argue that's going to happen now. Technically, markets now, and the stock market looks extremely valuable. I just put out a piece yesterday, how you are looking at a massive negative divergence on the new highs in the Dow and the S&P, for example. New highs in the stock markets is not confirmed by momentum indicators. Now, that doesn't mean that it will turn immediately, but that means that the market now is at a very, very high level of risk, and therefore that it is likely to turn sometime in the near-term future. I don't think that central banks can continue the game of fake money and fake assets. Let's remember that, as I said, they have printed 140 trillion roughly in the last since 13 years, but that has created the same amount of fake assets. When I made a calculation in one of my articles to say that extra money that they have printed, which is since 2006, the extra money of about 70 or let's say near 70 trillion, that equals 2 years of annual global output of actually everybody in the world. There are 3 million workers in the world today, or supposed to be 3 billion workers in the world today, and their output over 2 years equals the money printing that we have seen since 2006. So the world has just created 2 years of output by printing money, and that's why I'm saying that is not sustainable. That doesn't mean that fundamentally they will collapse today or tomorrow, but technically, in my view, markets looks extremely vulnerable, and on the timing cycles, etc., that I look at, we could have a top in the market at any time now, and then starting a downturn. Whether the downturn will be slow initially or whether it will start with a crash, it doesn't matter. Risk is at a maximum, and from our point of view, our company, we look at risk. We don't look at the final rise in the market and trying to catch that. We look at protecting the downside, because the upside is maybe a few percent, the downside is 95% in my view. I think that if we measure the stock market against real money, which is gold, of course, I think that we are going to see the Dow, for example, or the S&P fall around 95% at least against gold. But that would only take it down to the level of 1, i.e. the Dow equals 1 gold, just like it was or 1 ounce of gold, just like it was in 1980 when gold was 850 and the Dow was 850. That was the ratio 1 to 1 also of the Dow gold ratio. I think we're going to go down at least to 1 again, and I think we'll probably go below 1, but going down just to 1 would mean a fall of 95% of the Dow against real money gold. And I think that's going to happen. Now, I can't say exactly how and when, but I think the risk is there today, and I think people should be protected today.
It's not as if gold investors are suffering from this. I think gold investors are looking at this bubble really more out of curiosity, because gold, in fact, since the year 2000 has outperformed stocks. Gold, in fact, against every major currency in the world is making new all-time highs, except the US dollar. So gold investors are doing great. Thank you very much. So I think it's more of a curiosity here, because the stock market bubble fueled by all the money printing is really a once in no one's ever seen this before, ever in the history of the world. Has there been so much injection of ersatz, fake fiat money, to support really companies that don't make any profits? The companies that are going public don't make any profits, and they have no hope of ever making profits. A lot of the listed companies, 60% of the listed companies are not making appreciable profits, right? So this is a profitless prosperity fed by all this money printing. You have the Nasdaq up 40% last year, but it could be, on the verge of one of these situations like 1999, where you do see a final blow off on the Nasdaq. Another 85% jump in the Nasdaq would be in keeping with the recent manias. Egon, your thoughts on that?
As we know, market can extend further than we ever think is possible. But you have to remember, Max, that the Nasdaq is up 7 times since 2009. 7 times. This is a bubble now, which is equal to the 2000 bubble. I did forecast at the time, that crash there, and we got out of situations in e-commerce just before that crash. And I think, I can't say it's going to happen tomorrow. Of course I can't, but I can say that the risk is at a level which is totally unacceptable and should be unacceptable for anyone who's now investing. But of course, most people will hang on, just like they did in 2000 to 2002 when the Nasdaq fell over 90%. People who now hang on, I think they're going to lose the biggest part of their fortune, or at least the fortune or the wealth that they have in the stock market. So I'm not, catching that last bit. I remember every expert, everyone in the world, whether they were, petrol station or gas station attendant, or whether they were a hairdresser, or whether they were, a wealthy person, whatever. Everyone was an expert on the Nasdaq in 1999, and everybody jumped on the bandwagon the last year, and then they lost it all, and there wasn't an expert to be found in 2001 or 2 when the market had crashed. And I think it's not just, sure it can happen. I don't think it's worth waiting for it. I think it's imminent, but I might be wrong on it. But I don't care if it happens today or this week or next week, or if it happens in 6 months' time. The risk is there. And as you said, the Dow Gold, for example, I looked at the quarterly chart yesterday, and the Dow Gold on the quarterly basis has now turned down on the what is called MACD, which is a trending indicator. That turn down is the first time in 9 years that it's turned down. It's been going up since 2010, and now it's turned down. That is a very strong sign that the stock markets now are, in real terms, i.e. against gold, going to turn down. To see that turn, to me, is very significant. So I think we are there or almost there, and I don't really care if it goes up a bit further, because I certainly wouldn't recommend anyone to ride that. But I know that all investors that are in the markets today, they're going to think that the Fed, as you just mentioned before, they're going to, Fed and all the other central banks are going to continue to pump in money. But I think the market will soon realize that this money, this worthless money, fake money that they printed, is just creating fake assets. And therefore, the money is fake and the assets are fake. And that's what the world is going to be experiencing in the next few years, that all of that fake money, all of those fake values are just going to disappear out of the market. It will be sad for a lot of investors, and there'll be a massive wealth destruction. I'm not a pessimist. I'm just reading risk, and I'm just reading the markets, and it's inevitable that this will happen, in my view.
Well, this moving average of the MACD is fascinating. I think we should talk about that in the next segment. If you can stay with us, we'll do another segment, and that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Egon von Greyerz of goldswitzerland.com. If you want to reach us on Twitter, it's Keiser Report. Until next time, bye, y'all.